The Dustin Hasan investment philosophy. Dustin Hasan is CEO and founder and inventor of Millennial Dealmaker LLC, which is the first company in history to reverse engineer Berkshire Hathaway. My investment philosophy involves investing in leveraged buyouts of high cash flowing companies across all industries in the $1 to $50 million range and using the proceeds to buy and hold high quality assets. The key is to be a passive investor and to look to buy and hold for the long term. My investment philosophy involves trying to reverse engineer Warren Buffett's $1 billion mistake. His first mistake was purchasing Berkshire Hathaway, a rundown textile business, which he describes as a, moment, a monumentally stupid decision. Buffett knew Berkshire Hathaway was a troubled company, and the only reason he bought into it was because he thought it was cheap. Buffett's expectation going into the investment was to make a quick profit and get out, which he almost did. It was a bad move in which Berkshire Hathaway continued to struggle, and Buffett threw good money at the struggling business, trying to turn around the company's textile mills. Buffett had to close down Berkshire Hathaway's operations 2 decades later. But Buffett claims his biggest mistake came after the initial purchase of Berkshire Hathaway. Buffett's next mistake, however, ended up costing him and his partners over $100 billion. In early 1967, Buffett bought the right business that he would eventually be the seed of Berkshire Hathaway's investment insurance and investment empire. Buffett bought and merged the new business into Berkshire Hathaway, the publicly traded company that he still runs today. Buffett says if he had bought the insurance business called National Indemnity through his investment partnership hedge fund, he would still win at the time. He and his investors would have captured all of the investment gains he has created over the last 50 years. On the other hand, he shared all those gains with the public shareholders of Berkshire Hathaway. However, Buffett does not regret the decision because the legendary investor would have remained a hedge fund manager instead of being head of Berkshire Hathaway, the most successfully public traded investment partnership in history. There likely wouldn't have been 50 years of investment letters and Buffett's wisdom for all to read if this move was made. If not for this $1 billion mistake, there would be fewer letters to shareholders. Here's a breakdown of that deal. In 1967, Buffett bought Omaha-based insurer National Indemnity Company for $8.6 million. Instead of buying this company for Buffett's partnership Ltd., Buffett's investment vehicle for which he was investing at the time, and which held most of his personal wealth, he bought this company for recently acquiring Berkshire Hathaway. Buffett knew he wanted to be in the insurance business, and he knew the National Indemnity deal would be a long-term success. But how he executed the deal was a big mistake. Buffett has to ponder this mistake for 48 years to think about what if he invested through Buffett Partnership Ltd. Instead of Berkshire Hathaway. Despite all the facts pointing to his success, he opted to marry 100% of an excellent business, National Indemnity, to a 61% owned terrible business called Berkshire Hathaway. A decision that diverted $100 billion from BPL partners to a coalition of strangers. Buffett goes on to say the dumbest stock move he ever bought was called Berkshire Hathaway. And at the time, the partnership he was running had about 7 million assets under management, which would be considered a hedge fund now. Berkshire Hathaway was the base for everything after that point in 1967. And if a good insurance company came along, Buffett would buy it with Berkshire Hathaway. If Buffett created a new entity outside of Berkshire Hathaway, he could have avoided mixing the insurance company assets with the textiles assets. The textile assets were anchoring down most of Buffett's return over time and could have been avoided if he invested into insurance companies outside of the weighed down Berkshire Hathaway. Buffett carried that textile anchor for 20 or so years, and if he avoided putting the money into textile business originally and just started out with insurance company, Berkshire Hathaway would be worth twice as much as it is today. The astronomical figure would amount to $200 billion, but Buffett wanted to stay and run in the textile business, not the insurance initially. Warren Buffett took a buy and hold approach to the textile assets at the holding company level. and Buffett continued to make a long line of outstanding acquisitions after the National Indemnity acquisition to make up for the dismal economics of the textile business. If Buffett had just started acquiring businesses in the insurance sector from the beginning and avoided the textile companies, Berkshire Hathaway would be worth twice as much today.